In the next several videos, we are going to talk about whole life insurance policies. Our goal is, of course, always to maximize the cash value. That's what our company does, teach people we work with to maximize the cash value, short-term, long-term, and also the flexibility of their policies. However, when it comes to a whole life insurance policy, there's a lot of information. When we look at the different definitions and terms that are available, it can be overwhelming. But then when we begin to look at the different riders that are available that we can attach to our whole life insurance policy, there's a lot of information. And what I'll say is when it comes to different riders that are available, all riders have pros and cons. If you're interested, though, in a policy that is set up for maximum cash value, the purpose of this video series is to provide information and really the awareness to know, does attaching this certain rider, maybe it's a long-term care rider, perhaps it's a waiver of premium rider. Does attaching this rider give me the benefits, or does it really benefit my policy if my goal is maximum cash value? What are the pros? What are the cons? How much does it cost? When I compare it to a policy without that rider, is it really worth it? So we're going to go through different riders that are available in this video series, but we'll begin with the basics. Because when it comes to a whole life insurance policy, particularly if you're, again, interested in cash value, the design's the most important thing. And we talk about policy design all the time. Your money can go toward the base premium, PUA rider, most important thing aside from company selection. However, when we actually look at these terms on a life insurance illustration, what do they mean? What's the impact of me putting money into base premium if I've got a traditional whole life insurance policy or a 10-pay policy or a high early cash value policy? It can be confusing. So we're going to go over just that, and this video series is meant to primarily be whiteboard education, meaning we will not use Excel spreadsheets and illustrations like I like to use so much. It is meant to be much more basic. So I hope you enjoyed this video series. If you have any questions, please leave them in the comments below. Thanks so much, and I hope this helps. In this video, we are going to go over the base premium of a whole life insurance policy and how it works. So when it comes to the base premium of a whole life insurance policy, this is what purchases you a whole life death benefit. So for example, if you're in the market for a traditional whole life insurance policy, say it's $1 million, and you asked how much it costs, well, it will depend on your age, health rating, and a number of other factors such as the product you select, but you will see a premium due of X amount of dollars. We'll go over a couple examples shortly. Whatever that base premium is, with respect to your cash value, it's typically very low in the beginning. In the first and second year, it's often zero with traditional products. That is not the case with all products. Some products will give you a percentage of that base premium that shows up in cash value immediately. What you'll also see with the base premium is that it will generate the lowest guaranteed cash values when we compare it to dollars that could be paid toward the PUA rider. We'll touch on that a little bit more in our next video. So let's go through this in a little bit more detail, shall we? So if we look at the base premium, let's start with a traditional policy approach. So if you're going to purchase a whole life insurance policy and you just say, hey, I want $1 million in life insurance, it'll depend on your age, health rating, gender, a number of factors, but let's just assume you're purchasing a death benefit. I'll put this in gold. Death benefit, $1 million. And you ask, how much will it cost? Well, again, we mentioned it will depend, but we'll assume for this example, the actual premium is $20,000 per year. So that's the premium that you pay, and what you get in return is a whole life insurance policy, a whole life death benefit. As long as you continue to pay the premium, the death benefit will remain intact. There's a bit more to it, but we're going through just the basics in this video. So that $20,000 premium, what will it look like? Year one, you pay that premium, and with respect to the policy, you have a death benefit of $1 million. So DB, $1 million. However, cash value, let's put this in green, if you have a traditional policy. When I say traditional policy, what this is referred to on your life insurance illustration or formal contract will often be a whole life 100, an L121. Let me just provide a quick example here. Traditional equals life 100. And what that 100 represents is the age that you can make payments to the policy if you wanted to. Now, not everyone pays up until the age of 100, but that's how long the base premium is contractually due, for a long time. So what will happen in this particular case, going back to the cash value, assume this is your policy, you paid 20 grand, you've got a $1 million death benefit, but you have nothing to show for it in cash value. Zero with a traditional Life 100 policy. Maybe it's a couple $100, a very small percentage of that base premium. But what you'll typically see with these more traditional type policies is what we see in the first year also occurs in the second year. So you make that same $20,000 payment, which does what? Get your total payments to what? You pay $20K in year 1, $20K in year 2. So what's your total out of pocket thus far? $40,000. And your cash value is still a zero. It might be a couple $1,000 if you did begin to receive some dividends based on the guarantees. It'll often be a zero here. However, you still have a death benefit of $1 million. Now, beginning the third year, what you'll typically see with a traditional policy is that that base premium begins to show up in cash value. It's often not the full base premium. So if it's a $20,000 payment, we might see $15K show up in cash value. But then what will happen is each year, more and more of that base premium will come back to work for you, meaning in cash value. It begins to earn the guaranteed rate, begins to earn dividends, and the growth picks up year over year. What will also happen is you'll begin to see your death benefit appreciate. The reason why is because dividends will be paid to your policy. And as dividends are paid, often you'll see that dividends are reinvested into PUAs, that stands for paid up additions, that is deposited into our cash value, but it also purchases us what is called paid up additional life insurance, added death benefits. So what we might see in a case like this is now we have $1,010,000 in life insurance. Might not be that exact number, but my point is as the cash value begins to grow, so will the death benefit. And when you die, whatever that net death benefit is, that's the amount that is paid out. But the base premium here, so we continue to pay that with a traditional type policy. It'll typically take somewhere between 10 to 15 years before you break even or get your money back. So what that means is over 10 years at $20K per year, you would have paid in how much? $200,000. And your cash value might be $160,000. So you've got less than what you paid in. However, as you continue to make payments, eventually you will hit a point where you have more money in cash value than what you have paid into the product. A policy that has 100% of your payment directed toward the base premium is typically not a good idea if you're interested in maximum cash value. So when someone says, I'm getting this policy because I have a laser focus on the cash value, that's what I am interested in. Maybe the death benefit's important, but the cash value is what I want. I want as much as possible. In order to get that policy with as much cash value as possible, we typically recommend reducing the premium as much as we possibly can. Because premium dollars do not build cash value in the early years, again, with traditional products, to be very clear there, and they also deliver the lowest guaranteed cash values. So a little bit more on this before we wrap this video up. We mentioned traditional product. I said that word how many times? 10? Too many times. There's a lot of life insurance products out there, particularly whole life insurance products. So when we look at other types of whole life insurance products that are available, we have the traditional. So a traditional, depending on what company you're looking at, will usually be called, perhaps it's a L100. Sometimes there'll be WL standing for whole life, 100, an L121, an L99. These all represent the age that the premium is actually due until. So with these types of policies, you'll often see nothing show up in cash value in the first year and often the first and second year. Now, some companies will have a product name. So they'll call the product whole life insurance or select whole life insurance. They all have different names. I don't want to mention any specific names to isolate any companies, but you'll see a name that does not have a number. So what you want to do in that particular case is look in your illustration and look for this term here. How long is the premium payable for? And typically you'll see something like payable to or until age 100 or age 121, which again means that's how long the premium is due. Does that mean that's how long you have to make premium payments? No. You'll have options such as a premium offset, automatic premium loan, reduced paid up. We can do a face amount reduction, all things to reduce or eliminate our premium after starting a policy, which we'll hit on in later videos. But a traditional policy, if cash value is your goal, typically gives you zero upfront, and then eventually you see those premium dollars come back to cash value. Then you'll see a lot of other products available as well. Another type we'll see is what is referred to as a limited pay product. So a limited pay policy, it's kind of in the name here, limits the actual number of years that you can pay into the policy. The best example would be a 10-pay policy. Guess how many years the premium is due with a 10-pay policy? 10 years. After 10 years pass, what happens? Well, premiums are no longer due. We cannot pay more money into the policy. Is the policy still in force? The answer is yes. The cash value continues to grow, and so does the death benefit. However, I cannot add any more money. A lot of people like this option if they are not into the idea of making payments for a long period of time. A lot of people also like this option if their goal is to maximize the cash value. Because even when we focus on the base premium alone, what you'll see with a limited pay product is A, they often generate the strongest internal rate of return compared to more traditional products, with all things being equal, same company, same individual, same out of pocket. But what you'll see is in the first year, instead of a 0, you'll often see somewhere between 30 and 40% of whatever that premium is show up in cash value. So instead of getting nothing right out of the gates, we get a percentage that comes back to cash value. A lot of people are attracted to that. Also, instead of 10 to 15 years, you'll typically see between 8 and 10 years, your break-even point, when your cash value will be equal to or greater than your total payments. Now, what I want to mention here, there's two ways to approach a policy. So let's say you're trying to choose, do I go with the traditional policy or a 10-pay policy? If you were just shopping for a $1 million death benefit, and you said, which one costs more? Which one will require a higher base premium on a yearly basis? $1 million death benefit. The traditional, we'll call this a L100. How long can you pay into the policy? Let's assume you're 40 years old right now. How long can you pay into it? Up until you're 100 years old, right? So what that means is because the insurance company knows you can make premium payments or it's due up until 100, the premium is only $20,000 per year. I say only $20,000 per year. You'll see where I'm going. Versus the 10-pay product, 10-pay, you're that same 40-year-old individual. How long can you pay into the policy? Until age 100? No, 10 years maximum. So what does that mean? If you're the insurance company, what would you do here? Would you charge the same $20,000? Meaning, knowing that you still have to pay a $1 million death benefit out and you're going to give more in cash value from that base premium payment? No. What you might see in a case like this is instead of $20,000, the premium requirement is $70,000. So when shopping for a whole life death benefit, the base premium is higher for a shorter funding period. And there's examples in between. You can see a whole life 65, a 20-pay, a 15-pay, all that have different premium paying periods. But generally what you will see is the longer the funding period is, the less the base premium is for that same death benefit. And this assumes you're just shopping for life insurance here. Why I say that is because when we design a policy for maximum cash value, if your goal is truly maximum cash value, not death benefit, what we can do is take a policy, regardless if you've got a whole life 100 or a 10-pay policy. Let's assume you're paying in, let's say it's 20 grand per year. Say that's your cash flow going in. Well, what you can do here is take both of those products and set the base premium at $2,000. And you do that in both examples. Now what happens is you've got a policy where you can dedicate everything else toward PUAs and really maximize the cash value. And now you're deciding, do I want a policy where I can only pay into it for 10 years? Maybe if you want to stop after 5 years, you really gravitate toward that option because you have stronger cash value. You will see that with the IRR. Or you say, you know what? I like this idea of having a low base premium, or I can easily commit to that, add another 18 grand on top of it for the total of $20,000, but I can keep doing that as long as I'd like. But we want to look at different options there. And we've got a ton of videos that provide actual case studies with actual numbers and such. But that will help one refine their decision-making process. Now, to provide a couple more examples here of different products that are available, we mentioned the traditional, a limited pay policy, such as a 10-pay. You'll also see many other limited pay products. You'll have a 15-pay. Some companies will have a 12-pay. Some companies will have what is referred to as a custom whole life, where you actually pick the premium paying period up front. Then you'll have other types of products. One is a high early cash value policy. What you'll see with this, first year, you make a payment, cash value, depends on the company here. A lot of times you'll see 80% of the premium show up in cash value in the first year alone. Very cash rich up front. A lot of businesses, a lot of companies are interested in these types of products if they're positioning the policy as an asset on their balance sheet. Some companies like MassMutual, their high early cash value product is available to just about everyone. Individuals can purchase it. Then you'll see companies like Guardian have what is referred to as an executive strategies whole life product, which functions as a high early cash value policy. First year cash value, a little bit stronger actually. 90%. I'm sorry, it's not 90%. It's 95% in the first year of the base premium. However, it has a minimum base premium requirement of $100,000 per year for an individual. If it's a company, the company has to commit to a $50,000 minimum base premium. But my point is, it's got a higher minimum requirement, but I see a nice chunk of change show up in cash value, and I can add more on top of it into that PUA rider. We're going to cover the PUA rider in a little bit. But my point is, we see different whole life policies available with different products, from traditional to limited pay to high early cash value. And there's other products as well. We've got product series videos that go through illustrations with different companies and a lot more information. If I were to summarize this, the base premium, just looking at that, it purchases you a whole life death benefit. Now you can add a term insurance rider, which increases the death benefit on your whole life insurance policy. However, you'll always have what is referred to as a base face amount. The base face amount is the whole life death benefit purchased from your base premium. And that base premium is due for the life of the policy. The life of the policy, well, I should say the premium life of the policy, that is however long that premium is contractually due, unless you elect to stop it early with the options that are available. So that was a decent amount of information. I hope it helped as far as just providing more insight when you're looking at the policy. How does it actually function? If it did, please hit the like button, subscribe for more, and we'll see you in the next video. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.